Hey, it's Eric Osnes from Homebridge Financial Home Mortgage with my weekly and end of the year wrap up for the week ending December 30th, 2021. Here we are at the end of the year. You know, every year I do a forecast of where I think interest rates in the housing market will go. And then this time of year, I like to grade myself on my prior year's forecast. So here's how we did. Last year, I predicted that mortgage rates would rise as we put the COVID crisis in our rearview mirrors. And we did indeed see rates rise in the spring, but then they fell in the summer, as that Delta variant hit, only to rise again in the fall on fears of inflation. Overall, the average 30-year mortgage rate went as low as 2.75% this year and as high as 3.45, settling in to end the year at 3.26%. So my grade, I think I earned an A for that, although probably not for all the right reasons. On the housing market, that's another story. At the beginning of the year, I predicted that housing markets would rise about 7% for the year, thinking we would very slowly kind of crawl out of the COVID crisis. Man, was I wrong about that. Prices in the Seattle market rose 28.1%, for the year. My grade, definitely a D, for that, for missing pretty much historical increases in pricing. Looking forward, for 2022, COVID will still play a role in the economy, but really all eyes are on the Fed. I sound like a broken record talking about the Fed, but it's so important right now. Tapering, rate hikes, and balance sheet runoff, the Fed's, basically stopping the reinvestment of the securities they've already bought, are all in the cards for 2022. Too little action by the Fed is going to allow inflation to continue rising. Too much will thrust us into a recession. History can teach us a lot about the Fed and their reactions to inflation. In the 1970s, the Fed chairman was Arthur Burns. He was a guy who ignored inflation, insisting that it was transitory. Sound familiar? As a consequence, inflation back then boomed from 7% in 1978 to 14% by the time he left office in 1980. Mortgage rates at that time rose from 12%, which is sort of normal back then, up clear as high as 18%. Ironically, that's when I started my career in banking and had to live through those periods of super high interest rates. In 1980, Paul Volcker was appointed to the Fed, and his primary goal was to stop inflation. He hiked Fed funds rate from 11% to 20% in 2 years. Inflation dropped. It worked. It dropped from 14% to below 5%, and mortgage rates declined from 18 down to 12%. But there were consequences to that. The S&P 500 declined 30%, and that tighter money supply thrust us into a recession in 1982. In the 1990s, under Fed Chairman Allen Irrational Exuberance Greenspan, inflation doubled from 1.75 to 3.5%, and mortgage rates rose from the average around 7% up to about 8.5%. Unlike Burns, though, Greenspan acted quickly by increasing the Fed funds rate right along with inflation. And as he did that, by late 1999, he had hiked rates from 4.75 to 6.5%. Inflation responded and dropped down to 1%. But as a consequence, the S&P fell by 50% by the fall of 2000, and we entered a recession in 2001. Today, under Jerome Powell, inflation has increased from 1.75% to over 7%. And until recently, Powell called it transitory, just like Arthur Burns. Under Powell, though, rates have not really skyrocketed because the Fed has been purchasing mortgage-backed securities to keep rates artificially low. But history has taught us too much stimulus causes inflation, and here we are. And with this additional stimulus packages still working their way around Washington, D.C., the Fed's job of controlling inflation will become even more difficult. That along with the political pressure. Are we going into what they call a wage price spiral? That's when wages rise to attract or retain quality workers, definitely happening right now. But then the companies have to raise their prices to pay for those higher wages, and so on and so on. Rates need to rise to calm inflation. but too much could cause a recession and could also hammer the stock market. It's a lot to unpack there, I know. The bottom line is the Fed has to get this right. It's not an easy task. Fingers crossed. So, my forecast for 2022 mortgage rates. I would expect rates to rise a bit to about 3.75% this year as Fed tapering continues and rate hikes kick in March. Economists see the Fed increasing the Fed funds rate from 0% to 1% this year, or so, thereabouts. Rates could start to drift back lower towards the end of the year, though, or in early 2023 as the economy slows, which is likely to happen as those rates rise. So 3.75 is my forecast. The housing market. Housing prices will continue to rise, but not as briskly as they did this year. Expect prices in the Northwest to increase maybe 9 to 10% for the year, but there will be no housing bubble. The shortage in housing will continue throughout this year, which is why prices will continue to be pushed higher. To end the year, mortgage rates are still historically excellent. Here's the national averages today. Conventional 30-year fixed rates, 3.26%, up a bit from 3.16% last week. 15-year fixed rates, 2.6, up from 2.52 last week. FHA and VA 30-year fixed rates, 2.88, up from 2.75% last week. And jumbo 30-year fixed rates, 3.13%, up from 3.07% last week. As a final note, 2021 was filled with ups and downs, lots of drama, lots of pain as we and our loved ones face the challenges the year brought. I just hope for all of you that 2022 will bring you health and happiness, and that you will achieve your personal and your financial goals. Happy New Year, everyone.